Hello everyone! It's time to talk about a significant issue that could have a major impact on the real estate market in 2024. There's a factor that is on the verge of exploding and could potentially create waves throughout the market. I don't want to frighten you, but rather encourage you to think and be prepared. So, what exactly is this threat? Stay tuned, because we're about to delve into a situation that has gone unnoticed by many, but has the potential to completely change our understanding of real estate stability. This is something that could redefine the way we look at investing, owning, and even working within the spaces we call commercial real estate. And let me tell you, understanding this could mean the difference between riding out the storm and getting caught in the downpour. So, if you're as hooked on real estate as I am, you're going to want to hear this. Okay, so let's talk about this one factor that could possibly trigger real estate market crash. We're talking about debts. Nearly $1.5 trillion in commercial real estate debt is due that needs to be paid back by the end of 2025. A $2.2 trillion mountain of commercial real estate debt is expected to mature by 2027, creating a wave of potential distress. And it doesn't stop there. Morgan Stanley's experts are saying that the debt is going to keep stacking up even after 2025. They're looking ahead and seeing that in the next 4 years, commercial real estate properties are facing a big challenge. They've got to deal with paying off their debts, and it's going to hit the highest point at $550 billion in 2027. Now, as we can see, it's an extremely huge amount, and it's a clear signal that the commercial real estate market is in a very risky spot right now. But why is this such a big deal? Well, let's break it down. In a healthy market, debt maturities wouldn't be such a scare. Properties would be valued appropriately, interest rates would be manageable, and refinancing wouldn't be a scene out of a horror movie. But that's not the world we're living in. Interest rates have shot up, making the cost of borrowing more expensive than many property owners have seen in their lifetime. And to add insult to injury, office values are in a nosedive. We're talking about a scenario where properties that were once the crown jewels of portfolios are now looking more like weights dragging them down to the bottom of the ocean. Now, here's where it gets even trickier. A lot of loans are due to be paid back soon. We're talking a big pile of money that needs refinancing, which means getting a new loan to pay off the old one. If property owners can't get good deals because the rates are too high, we might see more of them unable to pay back their loans. This is bad news because it could mean losing their properties or hurting their credit. And it's like a vicious cycle, you know? High rates make refinancing costly, upping the chance someone can't pay their loan. This scares the banks, making them even more cautious about lending money, which just makes everything more expensive. If we're not careful, this could lead to a lot of properties losing value and even more financial headaches for people in the real estate world. And this situation is particularly dire for the office sector, which has been hit hard by the shift to remote work. So here's the deal. Working from home has become a big thing, right? Especially since that pandemic hit us. This big shift has changed how much people need office spaces. Remember how city centers used to be packed with people going to work? Well, now, many of those offices are empty because a lot of us are working from our living rooms or home offices instead. What does this mean for people who own these office spaces? It's pretty tough for them. First off, not as many businesses want to rent office space anymore, so the demand has gone way down. When demand goes down, so does the price they can charge for rent. That's basic business. Here's where it gets even tougher for these owners. Their buildings, which used to be worth a lot because they were in hot demand, are now losing value. That's bad news. Especially if they owe money on those buildings. It's like owing more on your car loan than what the car is actually worth. And owing money on something that's losing value is like trying to fill up a leaking bucket. It's stressful and feels like you're stuck in a bad spot without a way out. Not a good spot to be in, right? So we're seeing a big shakeup. Buildings that were once considered great investments aren't looking so hot anymore. The whole scene is changing. Owners are finding it hard to make money from these places, and it's even harder for them to get new loans because the buildings just aren't worth as much as before. It's a tough time for the office real estate market. This shift to working from home has really turned things upside down. Owners are feeling the pinch, and it's a big deal in the world of real estate. And where are the banks in all this? So, banks have always been the go-to when you needed to refinance your property, right? But now, things are getting shaky in the market, and banks are getting nervous. They're pulling back, making it tougher for property owners to find good deals to refinance their buildings. This reassessment follows significant financial turmoil, including the collapses of Silicon Valley Bank and Signature Bank, which has made these banks more cautious. This is a big deal because it leaves people who own buildings in a tough spot, trying to find other ways to get the money they need, and time is running out. Why are banks stepping back? Well, a lot of people are working from home these days, making it hard to predict what's going to happen with office buildings. Banks don't like risks, and the office market feels like a gamble to them right now. Plus, borrowing money is getting more expensive because interest rates are going up. This means it's harder for building owners to get new loans that aren't super expensive, and there aren't as many lenders out there willing to give them a shot. This situation is pretty bad. Property values are dropping, which means owners might not get the refinancing they need. This could lead to them not being able to pay back their loans, and we're already seeing more and more of these cases where owners can't pay, leading to some serious trouble in the commercial real estate world. Everyone's looking for solutions because the problem is urgent. In their hunt for money, some owners are looking at different kinds of lenders, like private equity or hedge funds. These guys might be okay with taking a bit more risk if it means they'll get more money out of the deal. Others are trying to team up with partners to share the risk and get the financing they need. But these routes can be tricky, often costing more and requiring tough talks. To make matters worse, a lot of commercial real estate debt is about to come due. This puts even more pressure on property owners. If they can't refinance, we could see a bunch of them defaulting on their loans, which could send shockwaves through the whole economy. In short, it's a rough time for anyone owning commercial property. Banks are cautious, options are limited, and the clock is ticking. Not a good spot to be in, right? But in the midst of all this chaos, some people think that there is still some hope that the Federal Reserve might step in to ease the pressure. Federal Reserve Chair Jerome Powell has expressed concern over the ailing commercial real estate market's beginning impact on banks, suggesting that the fallout isn't just a short-term issue, but a manageable problem that could take years to fully address. Powell's remarks underscore the gravity of the situation, highlighting that while the problem is manageable, it's more likely to affect smaller or regional banks, which have been pivotal in supporting the commercial real estate sector. The Fed cutting rates could help those struggling to pay back their loans, but it's not a surefire solution, and there's a big question mark on whether this help will come soon enough to stop things from getting worse for banks. Powell seems a bit hopeful, saying that even though some banks might go under or have to merge because of losses from the downturn in real estate, the banking system as a whole should be able to handle it without crashing like it did back in 2008. So, it's pretty tense, and everyone's watching closely to see what happens next. We're all hoping for the best, keeping our fingers crossed that thing would turn around. Now I'm pretty into real estate, and I've noticed something interesting. While a lot of the real estate world is struggling because of high interest rates and worries about debt, apartment buildings are holding up pretty well. And why is that? It's simple. No matter what's happening in the economy, people need a place to live. That's a fact. Here's the thing. As long as people are looking for places to rent, the multifamily housing scene will keep making money. This is great for folks who own these properties or invest in them, because it means they've got a steady flow of cash. This steady cash is key. It helps them keep up with their debts and avoid trouble with their loans. In a way, this keeps the bigger financial system from running into problems. Now, if the multifamily market stays strong, it could bring in more money. More money means building more apartments, creating jobs, and boosting the economy. It's a win-win. It's like this cycle that keeps on giving, helping to soften the blow if other parts of the real estate world hit a market crash because of debts. While the multifamily market is doing great, it's not a solution that can fix everything. It can't stop a market crash all on its own if things really go downhill in other areas. But its stability is like a safety net. It gives the economy a chance to sort things out without everything falling apart. So the whole deal with debt potentially triggering a real estate market crash is not just a threat we're trying to hype, it's seriously something to keep an eye on. We're looking at a situation where, if things don't change, we could see some real shakeups in the market. But you're not quite sure how bad it'll be. So, the only thing we should do right now is stay updated and informed. This way, you can make smarter decisions, whether that's investing in the resilient multifamily market or just figuring out your next move in life. But you know what would make a difference? If you hit the like button and subscribed, if you haven't done that already. So with that said, you guys, thank you so much for watching. I really appreciate it. And hey, if you're torn between renting or buying, craving more insights, or just looking to get your real estate fix, don't forget to check our other videos. Staying ahead of the curve and being prepared is what it's all about, especially in times like these.